Good morning, everyone. I hope that you are doing well. Welcome to this weekly review of the 16th of June 2024. It's a weekend review after CPI and FOMC, and man oh man, we had a phenomenal week when it comes to the price runs that we have seen. During this review, I want to discuss them with you. This review is being uploaded to YouTube so that both my public students as my mentorship students can watch it. For the mentorship students, you can watch a topical lecture on balanced price ranges within the mentorship platform as a weekend exclusive. With that being said, let's begin right away with this weekly review. Please take proper notes because I have many topics of importance that I want to discuss with you. First of all, let's take a look at the economic calendar of next week. As you can see, we have high impact news at 8:30 a.m. on Monday. On Tuesday, we have high impact news at 8:30 a.m. for the door as well, and at 9:15 a.m. we have some medium impact news. My game plan for Monday and Tuesday will be the following. My times of interest are both the morning as the afternoon session. I will be paying close attention to the delivery around the news events to see whether or not there are any setups that will be present, and next to that I will be paying close attention to the opening times. On Wednesday, we can see that we have high impact news for the GBP during the London session at 2 a.m. We have CPI. I anticipate CPI to come in hot, but we'll touch on that in a bit when we get to the GU chart. Next to that, we can see that it's a bank holiday for the dollar, so that means I will not be looking at Wednesday from a trading perspective, and I will not be even paying attention to the charts at all. Why? Because I do not want to trade on a bank holiday. On Thursday, we can see that we have high impact news for the GBP again during the 7 o'clock hour. And this is of importance because this is the beginning of the New York session. And therefore, we can anticipate massive volatility for the GBP again. And it's not surprising that we have this high impact news now. And we'll touch on that when we take a look at the GU chart. We can see that we have high impact news for the dollar at 8:30 a.m. unemployment claims. So my focus is going to be on both the morning as the afternoon session on Thursday as well. And on Friday, we can see that there's a lot of high impact news for both GBP as the euro during the London session. This is one day that is filled with landmines, so please be cautious of that when looking at the London session on Friday. On the door, we can see that we have high impact news at 9:45 a.m. So my focus on Friday is going to be on both the morning as the afternoon session, but I anticipate that after 9:45 a.m. we're going to see clean runs take place. Here we are on the daily chart of the dollar. As you can see, we had a very explosive week towards the upside on the dollar. The reason why this is important is because I have been anticipating for a few weeks now that we were going to form a low inside of this area on the daily chart of the dollar. I want to explain to you why I had that anticipation and how I was able to recognize the fact that we were turning from a sell program into a buy program. Because right now, it doesn't take a genius to see that the dollar is bullish. We have taken out the buy liquidity resting above this high, which has been our first objective for this run higher, and now we're monitoring to see what will occur next. I will break down to you why I was anticipating the dollar to form a swing low on the daily chart and begin to show signs of changing from a sell program into a buy program. However, because we did not see a clear low formation yet inside of that area, it's possible that we're going to draw outside of that. So as we're seeing here, close outside of it, and then I'm monitoring to see whether or not we're going to form a low in this area. As long as we do not trade below the April low, this is the scenario I'm monitoring. And the reason why I do not want to see the market trade below the April low if we're going to draw towards the upside and draw towards price liquidity is due to the following. What invalidates your idea when you're looking at a setup? Is that the closure outside of the imbalance, or is that the closure or slash the repricing below the first candle of the three candles that set up an imbalance? It's the latter, right? This low right here is the invalidation for this BC to hold. Not just the closure outside of that BC, no, it's the displacement below this low that's important. And hey, look at that low, it's the April low. And what do we know about the April low? We know that Euro and GU have traded above their respective April highs, whilst dollar has not traded below the April low yet. And that right there is why that low is so significant. And that's why this is the only scenario I'm interested in. There were signs present that confirmed this to us, and I will break them down with you. In order to do so, I'm going to put some lipstick on my chart so that I want you to focus on the lines that I will draw on my chart. Here I have annotated certain things on my chart, and don't worry if you don't understand the things that I've annotated right here. I understand that if you're completely new, you might be looking at this chart and you might be saying like, why are all these lines drawn across the chart right here? What's the significance behind them? Trust me, all of these levels that have been annotated make sense and they're logical levels. And I'm going to explain to you why they're logical levels. So let's begin. First of all, what I want you to see is the following. I want you to see how in April we formed a high right here and we then begin delivering lower very slowly. We can see this back and forth price action right here. May comes along and notice that the candle of May doesn't trade above the April high right here. Instead, we close below it and we deliver towards the downside. We begin to see a sell program unfold. The market reaches this discount BC right here and we retrace back into this upclose candle, form a high and then distribute lower, trading into the low of this large BC right here. We then consolidate and chop around until the month of June comes along. What we see is that a high forms right here inside of this CB's price range, and we then see this sudden drop lower. These 3 consecutive down close candles right here signal manipulation. They signal to us that we're manipulating towards the downside. And the reason why we're manipulating towards the downside is because we failed to displace below this BC. We saw a closure outside of it here, however we did not see the market trade below this low on this chart. You might be wondering why these 3 consecutive down close candles are manipulation that is taking place. The reason why this is manipulation that is taking place is due to the following. In order for a key swing low to form, we must first see manipulation lower. This manipulation lower has 2 functions. It takes out sell-side liquidity that was resting below the May low, because people went long inside of that area, they place a stop loss below the May low, we take them out, and secondly, we trap shorts below the May low, because there are people, retail minded traders, that short on the breakout of this low. And that right there provides us with the opportunity to buy in a very deep discount. Those shorts place a stop above this high, and that's the buy side liquidity that we can attack later. Now, who has been making money all along? During this run lower, people that were short, where did they place their stop? Above this high. So you need to keep in mind that within a larger fractal, as we're seeing right here, we're seeing a smaller fractal, and this is how liquidity is constantly being engineered day in, day out, week in, week out. And this occurs across all time frames. And this is very important to understand. Why is it so important that this low stayed intact on the CFD version of the dollar? The reason why this is so important is because both Euro as GU traded above their respective April highs. And this low right here was the April low. So whenever we're looking at these charts, we're not simply looking at, oh, this is a price pattern, this is a high or low that gets taken out, and now we should reverse. No. We pay close attention to the times at which those highs or lows formed, because it is the time-based liquidity that matters, and the reaction above or below the time-based liquidity signals to us whether or not order flow is bullish or bearish. And in this case, we saw manipulation towards the downside, the market traded below the May low, and we failed to take out the April low, whilst GU and Euro took out that April high. That right there is SMT. And as long as this low stayed intact, we can anticipate a low formation to take place, and we can anticipate the market to begin to show signs of bullish order flow stepping in. What confirms to us that bullish order flow has stepped in is the following. We saw NFP reprice towards the upside aggressively, and we saw the day after NFP, right here, Monday of this week, expand towards the upside, trading above this candle's high. Hey, this candle's high that formed inside of this CB, right? So what we see is the following. We see a CB, a high, and we see a BC form inside of the displacement leg above this candle's high. That right there is the market structure shift pattern. And this upclose candle, which has been annotated by these two red lines, is one bullish breaker. The reason why this is a bullish breaker is due to the following. We saw a low formation right here. This was the low of the month of May. We then retraced. I cut through this candle for now for this explanation. We form a high right here, and we then manipulate towards the downside. 3 down close candles that trade below the May low. The moment that we trade above this upclose candle, that upclose candle begins to function as a bullish breaker, and it should function as support on price. We would anticipate a low formation to take place, and then NFP comes along. And what do you see? NFP gets utilized for massive repricing higher on the door. So going into next week, my eye is drawn to simply one thing, and that's the following. This upclose candle right here. If the door is going to manage to displace above this upclose candle, and we begin to see it function as support on price, then this price action right here is our original consolidation and our target within a market maker buy model. Because if we see displacement above this upclose candle and this sequence of 3 downclose candles, I want to see them function as support on price, and then I want to see the door begin to show signs of running higher. I do not anticipate many retracements to come if that scenario is going to be in place. What we see is that a BC formed inside of the price range of that bullish breaker, as you can see here, and then the market takes out this candle's high, this buy side liquidity, it just trades above it with a small difference, and we then immediately reject it and retrace into the downside. The reason why that retracement was so important is due to the following. We retraced into a deep discount in the price range from this low that formed right here to this high. We saw news manipulate towards the downside, and then the news event later distributed towards the upside. Moving forward on the door, I'm anticipating higher prices to take place on the door. And the reason why I'm anticipating higher prices to take place on the door is due to the following. We have seen a point of interest get reached, the May low. During the month of June, we took out that low, and we failed to take out the April low, the low of the month of 2 months ago. So we have June right here, and during the month of June we refer to the May high and low, and we refer to the April high and low. Because we refer to those levels, we have data points, and with those data points we can work and we can anticipate what June is likely going to do next. And because we see this SMT on the lows right here relative to a previous month's low, I anticipate the market to begin to draw towards buy side liquidity next. What would invalidate this idea to me would be if we would begin to see displacement below this downclose candle's price range. I do not want to see the market displace below this downclose candle's price range and below this upclose candle, this bullish breaker, because then that means that this was not a low risk buy and that we're not going to see the expansions on the door take place as I'm outlining. What I want you to note is that the targets that I have are the previous month's respective highs, the high of May and the high of April. And this is how we're using time-based liquidity to navigate through the higher time frames. And the next slide of my presentation is a screenshot of a lecture that I shared in the past. This lecture is called Read Order Flow by Using Time Cycles, PXH and PXL Theory. What you need to understand is that a month is a time cycle, a month's worth of delivery. During the current month, we refer to the previous month's delivery. And during the previous month's delivery, we refer to the previous month's delivery. And that's how we keep on referring to the past to anticipate what's likely going to happen next. What we do is that during the current month, we refer to the high and low of the previous month, as you've just witnessed me do on the daily chart of the door, where you can hear me pay close attention to the monthly high and lows to anticipate what's likely going to happen next. And that is how you objectify your own analysis about the marketplace. And what's very important to note is that this right here is being done based on the daily chart. Now imagine if this would be fractalized and we would be paying close attention to, for example, a session inside of a day or a cycle inside of a day. It doesn't matter what you put inside of the time aspect right here. As long as you're paying attention to a time window, you can be paying attention to the same time window, but then in the past. So for example, the previous day, or the previous week, or the previous month. And this is how PXH and PXL theory is crucial for objectifying your own analysis and removing ambiguity behind why the market is doing what it's doing. So if you did not watch this lecture yet, I would highly advise you to do so. What we then see on the hourly chart of the door is the following. We can see that on Monday, we traded already above that up close candle, above that bullish breaker, and we can see that the market chopped around. Then during the Asia session, we consolidated right here, and during London, we then begin to show signs of bullishness, trading above the Monday high and trading just above with, I believe it was only 1 pip above the high that I had annotated on the daily chart. This right here is engineered buy side. Why? Because we did not manipulate above the high. Instead, we form relatively equal highs. The market then creates these CBs on the downside, we show signs of weakness, and the market begins respecting those CBs during the Asia session. On Wednesday, we open up, form a high above the opening price of the day, and we then begin to see signs of weakness. CPI comes in and immediately slams the door lower into a deep discount relative to the range from that low to high, into this large BC that got created during NFP. And here something very interesting occurs. What occurs is the following. We see signs of a low formation in this area, and then FOMC comes along during the afternoon session. At 2 p.m. and at 2:30 p.m. we had high impact news for the door. What occurs is that the door gets repriced higher, aggressively. And you might be wondering, what's this purple box on your chart? This purple box is a real algorithmic reference point. This purple box has been on my chart for about a month now. And every single time that the market reached this purple box, I was monitoring the reactions of this purple box. Where we saw on Friday NFP gets utilized to reprice above it, that purple box then began to get utilized as support and price. This purple box has been on my chart for about a month now. My mentorship students can confirm that this is the case, so if I'm lying, please share it in the comments so people can see that I did not have this purple box on my chart. But of course, as you know, this purple box has been on my chart for about a month now. I've mentioned many times in the past that this purple box is a real algorithmic reference point. And the reason why it is a reference point is due to the following. Every single time that price came into this purple box, we begin to see it function as true support or resistance. On Friday, we repriced above it, as you can see right here. Next candle opens up, finds support in that purple box and immediately expands away from it. CPI comes in, and what does CPI do? CPI immediately reprices through it. This is manual intervention that is taking place. This occurs to offer smart money the opportunity to buy in a very deep discount of the current range. They know that the low is likely in, so they anticipate that they're buying in a deep discount of a new range that's being established. FOMC comes along, reprices towards the upside. What occurs? They reprice it above the purple box and notice how IPDA comes back in control. How IPDA is referring back to that price range again and how the bodies are closing inside of it. On Thursday, we open up And during the London session, we have this sudden drop lower trading into this BC, and we see the market begin to show signs of strength. Then during the New York session, we had high impact news, and the dollar gets sent aggressively towards the downside back into that purple box. The market then immediately trades away from that purple box, and we begin to see the signs of bullishness that are confirmed the moment that we trade above the high of CPI. The SMT that was present was with euro. We see a new BC get created, and the market finds support inside of that BC perfectly right before the opening on Friday. This is institutional order flow entry drill that's taking place, and the market expands higher beautifully, trading above this engineered buy side, creating a new weekly high and reaching that new target. What is important to note on the dollar is the fact that we have now reached a target, and therefore we need to be cautious when it comes to holding on anticipations. The invalidations for higher prices have been outlined based on the daily chart. I do not want to see the dollar trade below and displace through this purple box again. I want to see bullish order flow now step in if we're going to in fact reprice towards the higher targets as I outlined. Daily chart dollar, daily chart euro. What I want you to see is the following. I want you to see how every single previous month's high and low have been annotated. The reason why I've annotated those is because I want to make clear to you that we in fact had that cracking correlation relative to the April high right here for euro and relative to the April low for the dollar. One thing that's very important to note is that if you would take a look at the dollar futures charts, and you would pay attention to this April low, you would see that the futures chart actually was utilized to reprice lower, trading below the April low and rejecting it. But the CFD chart did not, and that right there is a form of SMT. And for the people that are paying close attention, that are still watching, I'm sure many people have already clicked off because they're like, oh, a presentation, what else is there to be learned from this, blah, blah, blah. Those people will never make it because they're not patient enough. They're not patient enough to simply wait for a while and get to this point of the lecture. We're not even far in yet, and I'm sure some people are already probably bored of my voice or anything like that. Well, all good, doesn't matter. I hope you will find success, but that's not how I teach. You want to get the quick results. You want to just let me tell you, okay, this is what's going to happen next, this is what I'm anticipating, blah, blah, blah. That's not how you learn. You learn by listening to why I'm anticipating certain things to occur. You're learning by listening to the analysis, by listening to the logic that I'm utilizing to explain why I'm anticipating certain things to occur. And I'm not a financial advisor. Everything that I share during this review is meant for educational and or entertainment purposes only. But back to topic, I'm sorry. What you would see is that the futures contract of the dollar took out the April low, whilst the CFD did not. And that right there is a form of SMT. And for everyone that's paying attention to, for example, the Nasdaq futures and the Nasdaq CFDs, you would notice that this is something that occurs over and over again as well during key turning points. The same occurred right here on the highs of May relative to the April high for the dollar, CFD, and the dollar futures. Back to topic. What I want you to note is how the April low was left intact on the CFD right here of the dollar, whilst the euro took out the April high right here. This right here shows that manipulation is taking place and that we're potentially going to see a high formation on euro and a low formation on the dollar. What confirms this formation of a high on euro and a low on dollar is the moment we begin to see displacement through this upgo candle on the dollar, which was that bullish breaker, and for the euro, the displacement through this downgo candle, which is a bearish breaker. Notice that we then retraced into that downgo candle into a premium of this very large CB on the euro. We trade above CE and we reject it. Look at the body's closing below CE of that CB and inside of this downgo candle. The market then begins to show signs of rolling over, and right now we're drawn towards sell side liquidity. We have reached the sell-side liquidity resting below this low, which was of course our target, and I'm now monitoring to see whether or not euro will continuously roll over drawing towards this low and maybe even this low if it gets overzealous. This gets confirmed the moment we begin to see bullishness on the dollar continue. If we would take a look at both the euro chart on the left and the daily chart of GU on the right, we can see that this delivery all in all has been very messy, especially for GU. Notice that GU also traded above the April high, creating higher highs, whilst the dollar of course did not create lower lows relative to that April low. And what we see is that there's SMT taking place on the highs between euro and GU, where we saw euro roll over immediately. GU created another higher high, and therefore we saw SMT taking place, and that is what caused this huge sell-off to take place on both euro as GBP. We have reached the sell-side liquidity resting below these relatively equal lows, and I'm monitoring to see whether or not GU will manage to draw towards this BC right here, which is our target. The amount of pips that has to be achieved in order to reach this target is not that large, so I would not be surprised if we might even see it on Sunday if things get funky. And we have a lot of high impact news as outlined for the GBP next week, so that's why it's rather interesting to see these signs of a swing high formation in advance of those news events. If we would see the market immediately reprice back to the upside, trading above this specific down close candle, then the idea of a high formation is off. And then the overall analysis of sell-side delivery being next is off the table, and then we need to walk away and anticipate what's going to happen next. In my opinion, euro has been cleaner, and euro has also been the weaker market between euro and GBP, as you can clearly see, because euro is way ahead of GU, and that signals that for shorts, euro is also the market of interest. Daily chart Nasdaq. As you can see, Nasdaq has reached our long-term target of 19,600. We have seen very bullish order flow for the months of May and June. What started off with the displacement above this red box confirmed to us that we would likely going to see expansion towards the upside to take place. We initially targeted the 19,000 price level, and that is exactly where the high that has been annotated right here formed. We then saw the market begin to retrace into this red box, which was an inverted breaker. This is a very important concept to understand, and I will teach it now to you. Inverted breakers are the following. Where we saw on the left right here a potential bearish breaker formation, where we saw a high form here, low, higher high, lower low, we now want to see whether or not this down close candle will function as resistance on price. That's the concept of a breaker. However, because we were so bullish, we can refer back to this same price range from this low to this high to see whether or not order flow is going to displace through that range and utilize it as support on price. What you can see here is the following. You can see that in the month of May, we traded inside of this price range and we consolidated inside of it. We know that consolidation leads to expansion, and as long as we did not displace below the low of this red box, we can anticipate continuation higher to occur. We then see the market begin to expand towards the upside and the 19,000 price level gets reached. We form a high here and we begin to show signs of rejecting it. We retrace deeply. Now notice that this candle right here opens up and it formed a high and immediately reprices aggressively towards the downside. Where did the low come in? In exactly the price range of this down close candle. And as long as the market stayed above this red box, we were bullish on Nasdaq. We were anticipating higher prices take place. And this is how we're utilizing the same price range as we've utilized all the way in April in the month of June. And that right there shows how we need to look to the past in order to anticipate what is likely going to occur in the future. This is the concept of an inverted breaker. Just like we can utilize an inversion value gap to go long on price, can utilize inverted breakers to see whether or not we're going to continue higher after completing a market maker buy model. Because you need to understand that the move from this high, from the high of March to the low of April, to a new high right here, was one market maker buy model completed. And as long as we stayed above this down close candle, we anticipated continuation higher to occur. We then saw displacement through this high. We saw a strong closure above it, and what do we see? We see a BC form. Now notice how we respected this BC. Notice how the bodies are closing at the high of that BC. The wick straight inside of it, but the bodies are closing exactly at that high and at this high, which again formed at the 90,000 price level, which was our long-term target. We begin to see signs of continuation taking place, and the market expands towards the price target of 19,600. Notice that we saw very bullish repricing on Wednesday with both CPI as FOMC. This was a very explosive week, and longs were very profitable this week. Notice that we then closed above the 90,600 price level, and both on Thursday as on Friday we referred to this price level as an important price level. We are not in the business of calling tops, and as long as we do not see the signs present that confirm to us that a high is in, I'm anticipating continuation to the upside taking place. I'm monitoring to see whether or not we're going to reach the 20,000 price level. It's possible that we're going to fall short of it, that we're going to, let's say, maybe form a high in front of it, because it's of course a very significant price level. 20,000, it's a big figure. Everyone looks at it as, whoa, 20,000 for Nasdaq, that's a lot. Yes, that's the psychological effect of that level. So we might not reach it and stop in advance and make everyone like, why didn't we reach it? Just like we've seen with Bitcoin, of course, just stopping right in front of the 100k. Why is that occurring? Because everyone is so overly focused on that number. Does the market do it, forms a high in front of it, then begins to retrace to maybe reach that level at a later point in time. And that's how they're making use of sentiment to engineer liquidity for a later point in time. But as long as we're seeing signs of bullishness on Nasdaq, I'm anticipating continuation higher to take place. And that is how I'm treating these all-time high ranges. I'm simply looking for continuation until continuation doesn't work anymore, and until the time seems right for a swing high to form, and that's when we begin to see whether or not sell side is going to get attacked next. This was beautiful order flow, and I want you to see how we perfectly reacted off this candle's high at the 90,000 price level. Institutional order flow entry drill inside of this BC, boom, expand away. This right there is the characteristic of a very bullish market, where we don't retrace deeply into a imbalance, but simply tap into the top and then expand away from it. Let's take a look at the hourly chart to see what signs were present that confirmed to us that we were likely going to expand so bullishly this week. On the hourly chart, what we can see is that during the morning session of Tuesday, we saw SMT take place between both Nasdaq and SES on the lows right here. We then begin to see the market expand towards the upside after respecting this imbalance, this BC, from Monday perfectly. Look at the bodies closing inside of it. The market begins to expand towards the upside, and then we consolidate in advance of CPI. CPI then gets utilized to reprice aggressively towards the upside. This was a massive range that was delivered within simply one 1-minute candle, the 830 candle, and that is why you don't stand in front of CPI. Surely, if you were long, you are probably smiling right now. However, just imagine if this candle came against your position. Your stop loss will not save you. You will not get taken out at the price at which you put your stop to be at. And this is exactly the mindset that people experience when they're making use of prop firm challenges. When they say, look, I can take this trade and within one trade I can either pass or blow the challenge. And that right there is a gambler's mentality. I'm not saying that over the long run you can't have an edge with that, but predicting CPI, NFP or FOMC is not smart, and it is a bad mindset to hold on to, and that's why we always wait for those events to pause, and that is what a real analyst does. That is someone who is in here for the long run does. That is someone who has a long-term vision instead of just focusing on this one session. Be patient and wait and consistently do the right things. That's what matters. Personally, I waited all the way until FOMC to have delivered, and that's when I took a low resistance liquidity run towards the upside. I was targeting the 90,600 price level as outlined to be our long-term target. My mentorship students know that I've been referring to this level for a while now, but we just fell short of it a few points, and we then rolled over to the downside, and then post-market we delivered it. It is what it is, but that's what sometimes happens. This is again the engineering of buy-side liquidity below that level. And we see that during FOMC, the market consolidated and then eventually manipulated towards the downside to then distribute towards the upside. Beautiful AMD schematic based on this hourly chart. Accumulation, manipulation, distribution. We then trade above the 90,600 level and we begin to see the market consolidate. The reason why we begin to see the market consolidate and chop around is due to the fact that ES and Nasdaq were out of sync, as I will show to you in a bit. On Friday, we then opened up, drop lower aggressively, and ES takes out the Thursday low, whilst Nasdaq does not. This is again a sign of SMT. SMT ends consolidation. It signals that the time is right for the market to expand higher into that anticipated higher time frame direction, and we begin to see nice bullish order flow, trading above the London highs and above the previous day high, creating new all-time highs. And this is typical for such bullish order flow at all-time highs, where you seem to think, oh, it can't go any higher, and the market just continues to reprice higher. And that is exactly why it can be very uncomfortable if you're looking for longs inside of these areas, because you must think, well, I'm in a deep premium, right? Yes, you are. However, you're not in a deep premium relative to the current range from this high to this low. And that's why it's so important to know that you work from the inner ranges all the way to the outer ranges. And as long as we do not see the signs on the higher time frames that signal to us that we're forming a daily swing high, this is how I'm treating it. Hourly chart Nasdaq, hourly chart ES. As you can see here, you can see that cracking correlation on the lows between Monday and Tuesday between Nasdaq and ES, where Nasdaq created higher lows and ES created lower lows. And you can see the cracking correlation later down the line, where you saw that Nasdaq created higher highs on Thursday relative to the Wednesday high, where ES failed to do so. I did not annotate this on my Nasdaq chart because I didn't want to have too many lines, but you can clearly see that on Thursday we formed a higher high than on Wednesday. And note that on ES this was not the case. And then on Friday we formed a higher low relative to the Thursday low on Nasdaq, whilst on ES create a lower low relative to the Thursday low. This signals that Nasdaq is the leading dog for this bullish repricing, and this signals that all longs should have been looked at on Nasdaq, because Nasdaq was the market itself which was signaling that it was being repriced aggressively towards the upside, whilst ES is just lagging behind, and that can be very frustrating if you're looking at ES over Nasdaq for longs. And that's why intermarket relationship is very important to keep in mind when studying which market to trade. This is a rather long lecture thus far, and it's going to be the first time that I upload a review like this on YouTube. Please let me know in the comments if you find this insightful. This is what I do 3 times a week within my mentorship, 2 daily reviews and 1 weekend review, in which I just share my analysis going into the upcoming days, what I anticipate, what I'm looking for, what levels I'm monitoring. And what's fun is that the levels that I've been looking for within this whole repricing higher on Nasdaq have been the algorithmic reference points that on the lower time frames I've been trading off, meaning, for example, the 19,600 price level. This level functions as perfect support right here. What does that mean? This means that on the lower time frame you have a market maker buy model trading away from that level. Or for example here, you can see that we displace through the level. We then form a high just above the level, this is a lower time frame market maker sell model once we trade away from the level. Or again here, where this way is above the level, utilize the support, boom, lower time frame market maker buy model. Or on Friday, this way is through the level into a no significant level to us, form the low, boom, market maker buy model on Friday. Low of day that gets captured right here. This place above the 19,600 price level, retrace, go a bit below it, but eventually find perfect support at it, boom, reprice higher. And that's how specific levels can be utilized for lower time frame opportunities. And here comes a very important thing to understand. You need to understand that all it takes is simply one hyperbole trade a week. And I just explained to you how with this one level there were multiple opportunities within 2 trading days. And there were 5 trading days inside of this whole week. Just imagine how many opportunities there are each week that one could look to engage in on their own desire. I'm not telling you to go out there and invest, of course. I'm not telling you to go out there and trade. But this just shows to you that there are a lot of opportunities each week that one could capitalize on, and therefore experiencing a sense of FOMO, fear of missing out, or experiencing the feeling of, oh, I need to be trading right now because there will not be an opportunity tomorrow, is just, it's stupid. I can't word it any different way. There are so many opportunities each week that it's just, if you would count them, you would probably get to numbers that you would be surprised of. Because right now, you're probably thinking of, oh, tomorrow I need to trade. Tomorrow I need to go out there and push a button because it's Monday. We have seen a lot of explosive delivery. We have seen new all-time highs get created. Let's go out there and push it. And that's exactly the wrong mindset to have. You can't go in the markets with that mindset. You need to go into the markets with the mindset of, okay, I have a protocol. Is my protocol telling me right now to do something? And if your protocol is telling you to do something, then there's a setup. And not because you want there to be a setup. And there's a big difference there, which separates us from retail traders. Surely we are retail traders. We're not professional traders. We're not licensed traders. I'm not even licensed to share my thoughts with the markets. I'm just sharing my own opinion. I'm not giving you financial advice. However, you need to understand that we can think like professionals do. Meaning, professionals work based on scripts. They have simply game plans that they follow every single week. It's the same thing over and over again. And there are no changes that are being made unless the data suggests that a change has to be made. But as long as the data suggests to keep on following the same protocol, they don't make any adjustments and they just go into the marketplace with the same protocol every single week. And that's what I want you to learn. And I hope that this review has provided you with the insight to watch over my shoulder whilst I gave my analysis from a very objective manner. There's no surprise to me when price does something. I already anticipate what's going to happen next week. And when I see the signs present that confirm to me that something is going to happen, all I have to do is wait for confirmation of that thing occurring. And what then occurs speaks for itself. Daily chart of ES. What I want you to see is that ES has reached the 5,400 price level, which was a long-term target. We displaced through it on Wednesday and we created this BC. Notice where the low of day on Friday came in. We have seen very bullish order flow on ES and every single discount array has been functioning as support on price. Notice that we completed a market maker buy model once we traded above the March high right here. The market maker buy model was from this high to this low and from this low to that high. Notice that we did, however, trade below this down close candle and that already signaled that Nasdaq was the market to look out for longs because ES had to retrace deeper than Nasdaq did in order to continue towards the upside. And that was one of the signs that was present to me that confirmed to me that we were likely going to see a more bullish expansion on the Nasdaq over ES. Now moving forward, the same analysis applies to ES as it did to Nasdaq, where I'm anticipating continuation higher to occur until proven otherwise. We have reached 5,400 as outlined and now we're monitoring to see whether or not this level will function as support on price to continue higher. As long as we stay above this BC, this is the scenario I am working with. Until the signs become present that a swing high is forming on the daily chart, this is what I'm working with. I want to wish you good luck this week and please be safe. I hope that this review has given you some insight in how I view the markets from a very objective perspective. I believe I've made myself very clear when it comes to my anticipations, what I'm looking for, what confirms to me that something is going to occur. And I hope that you have gotten a great insight on how I objectively analyze the markets. My training is based on one protocol, and that protocol might seem very advanced to you right now. However, in due time, when you start understanding it more, things will become clear to you, and then it will become second nature. And once you understand that I'm doing the same stuff based on time and price cycles over and over again, you get to see how these markets really print. And once you see that, there's no ambiguity behind them anymore, and every single move can be anticipated. This doesn't mean you become profitable right away, or even at all, because that's something you have to make sure for your own. I can't guarantee that you'll become profitable. However, what I can guarantee you is that you will never view the markets through the same lens again. With that, this review comes to an end. I hope that you found it insightful. Please leave a comment saying what you thought of it. If you want more of this, please leave a like as well. And I look forward to catching up with you in the next video. Please be safe.